Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories behind your favorite company's financial reports. And today we're diving into LXP Industrial Trust's latest filings to see if their debt management is as solid as their real estate holdings. So LXP Industrial Trust is making some big moves with their debt, and we're going to break down exactly what that means for investors and for the company itself. Before we dive in, if you love getting these kinds of clear, straightforward explanations of complex financial documents, make sure you hit that subscribe button and ding the notification bell so you never miss an analysis. And if you want to chat with us and other finance enthusiasts, join our Discord community, linked down in the description below. Alright, let's get straight into it. LXP is talking about an offer to buy back some of its own debt. Think of it like a company saying, hey, we have some IOs out there and we want to buy some of them back early. This specific offer is for their 6.75% notes that are due in 2028. They had a goal to purchase these, capped at around $150 million. This offer was laid out in a document called an offer to purchase. It details all the terms and conditions. It is basically the official invitation to debt holders to sell their notes back to LXP. They set a deadline for lenders to respond, and that deadline was the 15th of October 2025. Now here's where it gets interesting. By that early deadline, over $186 million worth of these notes had been offered back to LXP. That is more than they initially planned to buy back. When this happens, it means the offer is oversubscribed. Because the offer was fully subscribed, meaning more people wanted to sell their debt than LXP wanted to buy, they announced they will not accept any more notes that were offered after that early deadline. This is a common tactic to manage how much debt a company takes on or sheds at any given time. The very next day, the 16th of October, LXP announced the pricing details for their offer. This is where they revealed how many of the offered notes they would actually accept. Since the amount tendered was more than the $150 million limit, LXP will not be buying back all the notes that were offered. This is a key number. The proration rate tells us how much of each debt holder S offer they were actually going to accept. In this case, LXP is accepting about 75.3% of the notes that were offered by that early deadline. So if you offered $1,000 worth of debt, they'll buy back about $753 of it. Ultimately, they will purchase a total of $140 million worth of these notes. This is slightly less than their initial $150 million target, which might suggest they really wanted not to go above a certain amount, or perhaps they saw an opportunity to save a bit more by reducing the purchase amount slightly. The actual exchanging of money for debt will happen around the 20th of October. This is when the money changes hands and the debt is considered bought back. This whole process shows LXP actively managing its debt structure. They essentially refinancing or reducing their debt burden, and they redoing it at a time when they have strong demand from debt holders to sell back. The details of the early tender results were announced in a press release on the 15th of October, and then the pricing was released on the 16th of October. These are being filed as exhibits to this report, so anyone can go and see the exact wording. Looking at their registered securities, we see they have common stock trading under the ticker LXP on the New York Stock Exchange. They also have preferred stock, the 6.50% series C cumulative convertible preferred stock, also on the New York Stock Exchange under the symbol LXPPRC. This tells us LXP is a publicly traded company with established lines of stock. As a real estate investment trust, or REIT LXP, S business involves owning, operating, and developing income-producing real estate. Typically, REITs have a lot of debt to finance their properties, so managing that debt effectively is crucial to their financial health and profitability. Now let's dig into what this debt buyback really means. By buying back debt early, LXP is likely trying to reduce its future interest expenses. Those 6.75% notes are a specific cost to the company. If they can buy them back at a discount or simply reduce the amount of debt on their books, they're saving money in the long run on interest payments. This can free up cash flow that can be used for other strategic initiatives like acquiring new properties or paying down other higher interest debt. The fact that the offer was oversubscribed is a good sign for LXP. It suggests that the market views LXP S debt as valuable, and that LXP is being perceived as a stable company that can meet its obligations. Creditors are willing to sell their debt back, indicating they might trust LXP, S financial standing, or perhaps they see a better investment elsewhere, but the fact is LXP got them to sell. From a Warren Buffett perspective, this is like finding a good deal on a piece of property you own the value of which you believe in and deciding to buy it back for less than your perceived value. However, we also need to consider the overall debt picture for LXP. While they are actively managing this specific debt issue, it is important to see how this fits into their broader leverage strategy. Are they taking on new debt elsewhere to finance this buyback, or are they using internal cash? Are their rental incomes strong enough to support their existing debt obligations and any new ones they might take on? These are the questions that really matter for long-term investors. One potential risk here is that by buying back debt, LXP is reducing its cash reserves. While this might be a strategic move to save on interest, it could also limit their flexibility in the short term if unexpected opportunities or challenges arise. The proration rate also means some investors who wanted to sell might not have been able to fully do so, which could affect their perception of LXP. Overall, LXP Industrial Trust appears to be taking proactive steps to manage its debt. The successful early tender results and the announcement of the pricing indicate a company that is in control of its financial strategy. They re-leveraging a strong market demand from debt holders to optimize their balance sheet. The key going forward will be to watch how this debt reduction impacts their overall financial performance and their ability to grow their real estate portfolio. Are they strengthening their foundation or just rearranging the furniture? Time and further financial disclosures will tell. Alright, that is our breakdown of LXP Industrial Trust's latest filing. What is your take on these numbers and what they signal for the company? Future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.